When we classify costs, another classification of costs are inventoriable costs and period costs. Inventoriable costs are costs that are capitalized at the time costs are assumed. For example, when inventory is purchased, that cost is capitalized and that becomes an inventoriable cost. Then there are also period costs, like for example, buying petrol for transportation. That's expense during the reporting period that becomes a period cost. When it comes to type of inventory the inventory can have three categories of costs: direct material, work in process, and finished goods. These direct materials are converted into work in process, and that work in process become finished goods. Direct materials would have direct material costs, and then that direct material is then with manufacturing labor and other manufacturing costs which are not direct but are indirect. They are being converted into towards outputs, and they are embedded in work in process and finished goods. Inventoriable costs are all costs of a product considered as an asset. So in the manufacturing sector, all manufacturing costs are inventoriable costs. In the services sector, all costs of purchasing goods are therefore resale, so often they are considered as period costs. So when we look at the manufacturing cycle, manufacturing costs, the inventoriable costs, when they become work in process, they are still inventoriable costs. When they become finished good, they're still inventoriable costs because they're shown on the balance sheet. And then when they are ready for sale and being sold out, that becomes cost of sales, and then it becomes period costs. Indirect costs, for example, rent, electricity, depreciation, are not always period costs. Because some cost objects output exists for more than a year. For example, in manufacturing, they become assets. So then that asset becomes an inventoriable cost. Some cost object output exists for less than a year, and those cost objects are incurred, and they, like for example, research or distribution, and they become period. Let's look at how we compute total manufacturing costs. So there's beginning inventory, purchases, ending inventory. Then there's direct manufacturing labor costs, and there's manufacturing overhead costs. So we need to calculate the total manufacturing costs incurred. Direct material used here is 12,000 plus 85,000, and we have to take away the inventory that was not converted into finished good, which is 7,000. That equals 90,000. total manufacturing costs are the direct materials used 90,000 plus direct labor costs incurred 30,000 plus the manufacturing overhead costs incurred 40,000, and that becomes 160,000. Prime costs are direct manufacturing costs. So they are the direct material costs. In the example we took, it was 90,000, and direct labor costs, which is 30,000, and the prime cost is 120,000. The conversion costs are the costs incurred in converting the direct materials into a product. So there's direct manufacturing labor cost of 30,000, and then there's manufacturing overhead of 40,000. So the conversion cost is 70,000. This cost is required to convert the material into finished products. Two methods of costing inventories in the manufacturing industry are variable costing and absorption costing. In the variable costing, all variable manufacturing costs are included regardless whether they are direct or indirect for cost calculation, whereas in the absorption costing, all variable costs, direct and indirect, are included. Additionally, all fixed manufacturing costs are also included in the costing calculation. It's important to understand the implications of fixed versus variable costs to enterprises. If you look at the staffing costs, the full-time staff can be considered as fixed costs, and the casual staff can be considered as variable costs. And for these two categories of staff, there are additional costs that are involved in addition to their salaries. These are called on-costs. There are some common on-costs to both categories, which is the superannuation guarantee, workers' compensation insurance the enterprise must take, and the payroll tax that the enterprise must pay. But it's in some states, and it can vary, the rate can vary. And then additionally, there's annual leave loading and long service leave loading that applies to the full-time staff, but does not apply to the casual staff. So there are two aspects here. One is the casual staff costs can vary with the volume of production, can align with the volume of production, and also the casual staff, which is the variable cost, could be cheaper, less costly than the full-time staff in that alignment.